What is going on? What is happening, guys? How's it going? Good morning. Again, here to spend a couple of hours with yours truly. It is Professor Meatball. He's wearing his I Love Tacos shirt. You know it's Taco Thursday. But what's better than Taco Thursday is saying thank you guys for those of you who show up first. As you know, if you show up right at 8 a.m., you're going to win a raffle because we're going to have a word from our, let me see your drum roll. Oh, my keyboard is not plugged into anything. It's time for our sponsor of the day. We'll be back in about 60 seconds, and then you guys will win a raffle. Give me a hot sec while people jump in, and we'll see you in a second. Pew! Meatball knows that I play double or nothing, which is why, if you guys wanted to double your money in 15 minutes, I have a pretty cool thought. Stock Battle. That's right. You can find a pretty cool app on the internet that not only is kind of like fantasy football, but it's also with stocks and crypto. Stock Battle uses real-time data from Nasdaq and Yahoo Finance, and players have free rolls to try the contest. You can also double your deposit up to $50. You compete with rivals of the same skill level, not with hedge funds or the traditional stock market, so everything is fair. Players use their trading skills to have fun and win with real money, and players can withdraw money you win. So it would be great that I personally tell you that I enjoy this product, which is why I am recommending it to you. You guys are getting the Andrew Mo seal of approval. Again, if you guys wanted to tweet me pictures of you using this app or follow me on Instagram and send me some pictures there, then I would be looking forward to seeing what you guys do on Stock Battle. Look, once again, Stock Battle has 1.2 million contests finished. We got 153,000 active users, 23,000 contests daily. It is fantasy finance. I don't have to say anymore. Thank you guys for listening, and now back to your regularly scheduled video. Meatball, take us away. Wow, amazing. And that has Sleepy Meatball in the background as well. That was Andrew from the past saying, hey, thanks for showing up right on time. Let's do a quick trivia to make sure that you guys know that we are here for the green today. We got 2% up on GME, 2% up on AMC, and now here is the question that you might not know the answer to. We'll do a GME question related next time. What does AMC stand for? That's one of my favorite questions. A lot of people don't know this, but if you do answer in, I will put your name into a random number generator, and because you were here at 8 a.m. sharp, like Francis, like Justin, like DH72, like Jack Ali, like Justin, Lenardi, Curtis Davey, as well as Brian, Chris, Misty, A. Willis, M. Maximus, all of you guys out there are going to be able to win something in a second. So, answer the question. What does AMC stand for? We got American Movie Cinema. That's not correct, says Curtis Davey. American Movie Cinema is not right, BTS Sandwich. AMC, I'm just going to open AMC, the Wikipedia. It is American. It is American for sure. Everyone's saying American Movie Cinema. That's not right. Isn't that fun? We're learning something today. It is the first right answer. Alan Barron says American Multi-Cinema. That's right. American Multi-Cinema says right here. Wikipedia. Wikipedia can't lie. All right, so random choice. Alan, you were one of the first right answers. Misty's like me. Yeah. What's up, bro? This is Daniel Rodriguez. Good morning. Good morning, world. Hey, while you guys are commenting out the right answer to that trivia question, make sure to also, for the algorithm, comment out how you're feeling today. Right? Ask me. I'll respond. This is just a little powwow back and forth. We got BTS Sandwich saying the right answer. It's what American Multi-Cinema. We got Alogist. And then finally, we have Dave Zines. All right. Even if you don't see your name up here, you still have a chance to win. All you got to do is come back and leave a comment. And here it is. 3, 2, 1. Random choice. It's BTS Sandwich! BTS Sandwich! Send me an email. You know what it is. AndrewMoBusiness@gmail.com. And you'll see a little something in the mail coming very soon. Wow. Cool. Very, very nice. All right, let's talk about the stocks. While I was talking about AMC, it just had its fat rip off of the simple moving average that we had earlier in the day, right around 10:51, and then right as I started streaming around 11:02. So that means that we are now currently pressing up right underneath that VWAP, and that means smooth sailing. We can cross right over. We're looking for VWAP divergence. We're looking for the VWAP to be taking its bottom and giving us the lift that we're looking for. Hey, cutie patootie, says Nikki Pites. What's up? Oh, BTS Sandwich says, yes. Look, agree, says Johnny Vu. Sure, we'll take a look in a sec. Chris says, hey, Andrew, can you take a look at Lucid? Tell me what your thoughts are. Oh, yeah. Mad Hatter says, apes mad at Kramer. AMC. Perfect. Ball is afraid. Oh, just in the nick of time. We'll also get you in the next. We'll get you in the next raffle. PGS says, I'm gonna buy another GME share because I'm lucky. Apes mastering control. Can't stop, won't stop. GameStop says, happy to see GME and AMC both green on the day. When are you and Atoba going to do another thing with Congressman Ro Khanna? We've done it once. We'll do it again. Congressman Ro Khanna is my congressman here in the Silicon Valley, and we had him on the show in a very cool little interview. And we'll be able to have him come back again when Mr. Atoba and I, along with the people that made that interview possible, come back together and talk about the tactics. How do we get our voices heard by the policymakers who need to make those choices? These are the questions. Let's take a look at the data. We got the Stonko tracker right here. 40.98 right here for AMC. Trigger price for the short sale restriction list is $36.07. Not likely for the day. And 28,000 calls expiring in the money this Friday alone. 45,000 of which will be in the money when we hit $45. It's $4 away. Trading volume looks like it has hit major strides in the beginning of the market, as always. And then there's a bit of a, I think it's like halving. There's like a half-life here. So 10 turns into 5, turns into 3-ish, turns into almost nothing. But it's because we just started the hour. So borrowed shares right now, 650,000. That seems pretty steady, but we can always look at more on iBorrow desk. And then options data for the rest of the month. Apes make cash. AMC, my 10% profit. There it is. Oh, man. Cost to borrow. Look at the cost to borrow here. Cost to borrow is right here. So that's that fee. 0.8%, 1.1%. It is fairly standard. Okay. AMC, short interest. Still holding that 20%. Here it is. Here's interest. There it is, 20.4% for AMC. So it's that short interest is really holding on tight. Sean Carter says, we are apes. Jim is a monkey, as he has a tail. Oh, wait. Andrew never claimed his NFT. Wait, Misty. I get an NFT? Send it again. AndrewMoBusiness@gmail.com. I really only exclusively religiously check my email. I'm kind of slacking on the social medias, but I will be checking my Twitter and Instagram more often. So it's right down here at Andrew More Money. Let's see. Kramer the Crybaby. You know, that's actually not a bad rapper. He's not a bad rapper. Kramer the the baby. And Caesar has the real right answer. AMC stands for Andrew Mocash. Andrew making cash. All right, let's take a look at what peeps are talking about right now. What is the hub of? So make sure that you guys know what to check this morning. Dow Jones Industrial Average opens positive. Obviously, it's a pretty positive day. Fed cuts outlook for growth. So we had the Fed day yesterday. We have some Kramerisms from that, and we have a little bit of what Fed is cutting in terms of outlook for growth. I'll take a look at all of that in just a second.
Financial institutions at risk. You couldn't let them collect yet. Hazard involved in people who were irresponsible with their mortgages, perhaps. You don't want to let the general public fail at large.
Yes, but I think that I've been saying that President Xi overreached here. because all the other things that he's done. I mean, when he decides to slap down the video games, okay, so cut down video games, cut down ride-sharing money, make it so that only David can find Jack Ma, who was once very influential. And then you get to this, and he really, I believe, wanted to get the richest man in China, which is the man who ran Evergrande, and the top people from Evergrande, and he wasn't able to do it. He wasn't able to surgically remove the money of the top guys without bringing down the edifice of a company that owes $300 billion. This is the first mistake I've seen him make.
But they also were slowing overall the property development cycle, right? I mean, there have been fewer people. I mean, that's in part.
I don't think
this is a company that was based on the next sale, very levered.
But do you think he knew?
I don't
people
know.
were like getting parking spots in return for.
I do.
You do?
I don't think that was a big secret.
Well, then why
We've been
couldn't
talking about a level
he
of
have guaranteed
speculation
them
in
at the
China for
beginning?
many years.
Why couldn't he just say, "Listen, here's the people who won't lose money"?
I don't know, but this
That's
is
what
far
I need
from
to know.
over, and we'll see how it actually ends up. Listen, land sales are a very important driver as well for local government revenue in China. And the question really also will be, I think, for so many U.S.-based investors, what does it mean for companies that do rely on the consumer in China? This is not done yet in terms of as a story. You know, is traffic into Nike stores at the same level it was?
Let's prepare for
what
that.
What is it going to mean for things of that nature?
See, I think that well, a lot of people who keep thinking that Xi is president for life. He is not yet president for life.
He keeps saying that.
And this is a very important constituency that he cannot afford to lose, which is basically housing. As David said, there's like a guy on the committee of the 7 who's in charge of housing, and he's trying to figure out right now, does Xi deserve to be president for life? I mean, literally, look, I'm not saying it's like, there's Democrats versus Republicans. I am saying that there is accountability. And even President Xi, whom we now regard as basically Mao or Stalin, he's not.
You're not saying he's not going to go for another round.
Oh, he wants another round.
I'm not saying he's Hitler and Stalin like other people are, because, oh my God.
I think he has to be more careful than he thought. I do not understand why people think that this country is necessarily united on someone who...
I love Cafe Ole saying, Kramer speaks poor English because I can understand him. Good morning, Andrew and Professor Meatball says, Wolfie Wild. Good vibes and green charts every day. Just dropping in to wish everyone the best. Oh, wholesome. That's the kind of audience you got here. That's the kind of moon platoon you guys got here.
May have made a major mistake here. It was a mistake. He is not that powerful that he can anger this big a number of people. When you hear that he says he's monitoring unrest, this is China, for heaven's sake.
Oh, yeah, listen, if you spend most of your life savings on an apartment that's not going to get done and has no prospect of getting done, you're going to be pretty upset.
Right, but I'm saying that he had to figure out a way to be able to bail out everybody. Look at those 4,000 people, the media. No one's talking about those people being disenfranchised. Right, they're getting to keep the money. That is not what she wanted. I'm just saying,
not what she
can
wanted.
we just stop thinking that everything she does is right? I'm not saying
We don't necessarily do that, but we are following this because of both what it means for the world's second largest economy and demand there, and secondarily because of continued concerns about contagion, even though those may be very well overblown in terms of you never know. We've certainly learned that from the past. That's why we're focused on this story.
Shep, okay, so let's have I'm going to make you sound smart at dinner parties, or maybe just pretentious. If you wanted to say she, like the English pronoun, people are going to be confused about who you're talking about. If you're talking about President Xi. So if you wanted to be able to say his name, maybe like when you say like Spanish words, you suddenly have like the correct accent. Like, my name is Roberto. So when you want to say President Xi, try to have that air push out from the side of your mouth. And then suddenly you just learn a whole new way to make sounds with your mouth hole, which is really kind of the whole point. Every day. That's kind of the point. Let's take a listen to what Fed Day has for us. Because yesterday, usually we were looking for a severe pullback.
The collapse of a major Chinese property developer could cause big...
Usually we're looking for a major pullback, especially since our current Fed chairman is usually responsible for a major pullback whenever he opens his mouth during Fed Day presentation. However, Yesterday wasn't as much of a bloodbath. In fact, today is another strong bounce of what has happened from Monday and Tuesday. So people might be thinking that the worst has already come. Well, let's take a listen to what the Fed covered yesterday.
As Andrew mentioned, stock snapping a 4-day losing streak after the Fed's decision to hold interest rates steady, but it indicated hikes could be coming sooner than expected. Steve Leisman joins us right now with more. Hey, Steve.
Good morning, Becky. For investors, yesterday's Fed decision can be looked at as the glass half full or half empty. Policy is going to be less accommodative, but it's going to be accommodative for a very long time. Here's the takeaway. The taper, well, likely announcement, it sounded like in November. Could be they start in November, but most people thought they would announce it in November, beginning in December. For rates, completed by the mid-year of 2022. For rates, the first hike either 2022 or 2023. If the Fed starts tapering in December and reduces by $15 billion a month, that means it will still buy $660 billion in assets between now and June 2022. That, by the way, is equivalent to the second quantitative easing program, QE2, in 2010. Fed Chair Jay Powell said in his press conference, he thinks the economy has passed the test.
Joselito, what's up?
Many on the committee feel that the substantial further progress test for employment has been met. Others feel that it's close. They want to see a little more progress. There's a range of perspectives. I guess my own view would be that the substantial further progress test for employment is all but met.
On rates, the Federal Market Committee split 9-9 on whether the first hike is in 2022 or not. 17 of 18 see a hike in 2023. So median funds rate 1% for 2023 and 1.8% for 2024. Fed funds probabilities currently show a 65% chance now of a December 2022 rate hike. That's about where it was before the announcement, so it was already really expected. Zero rates and asset purchases, remember, they were pandemic emergency programs. They're going to hang around now well into next year, we learned yesterday, even while the economy has come a long way from the worst days of the pandemic. Becky?
Becky? Becky? So, it seems like taper is coming somewhere in the next 1 to 2 years. But even though that might happen, government's still spending lots of money. And at the end of the day, that's what the economy needed to hear. Or yesterday, the short term. But will it be sustainable in the long term? No, but we'll find out. Now, let's see. Inside the courtroom of Theranos. Oh, that's right. Theranos is going to court. Al wants to give a dovish message, right? That's what happened earlier. But this was from earlier today. So let's take a quick listen about one final thing from Mr. Powell.
With you, I kind of smiled because you said that the Fed chair was more hawkish, but his overall tone was dovish. So that's the perfect. That's what I guess we figured that was going to be what he tried to thread as far as a needle goes. But you thought he was successful.
Yeah, I mean, he has a lot to juggle. I do think he overall wants to give a dovish message. They're not in any hurry to raise interest rates. They're just starting to embark upon tapering of QE, which we know they need to finish. At least they told us they'll finish that first. That's their playbook unless something unexpected happens. But at the same time, the dot plot estimates, the interest rate expectations all moved higher, and they're split now whether they should raise interest rates next year, so have rate lift off. So he had to balance all of that. Kind of what struck me is, yes, it was a dovish message, but it was a little less so. And the question is that really his feelings, or does he have to represent, the entire committee, which is moving a bit more hawkish?
When you add everything that the Fed is dealing with you've got these. It's all related to COVID, I guess, because the bottlenecks are related to COVID. So you've got this possible inflationary period that we're heading into that may or may not be the Fed's fault, may or may not be transitory, but you've also got fears of a possible slowdown if we don't get the variant under control. So it's very difficult they kind of have to do both things, but we do know that asset inflation is everywhere too. So I don't envy what they're trying to do. Can they do it successfully, or do you think there's already a problem for where we are?
Well, there are a lot of risks, and interestingly, they release their own perspective on the uncertainty surrounding their forecasts, and it's the highest in about 8 to 10 years, both on GDP and inflation. And the risks are much higher now on inflation when they're evaluating their own forecasts, and they see increasing downside risks to GDP. So that's not a great position to be in, frankly, as a central banker. We'll see how they can navigate it. There's lots of challenges, headwinds both ways. And I agree with you, Joe. I think the key are the supply chain issues. And if those can get worked out, it means we can have stronger growth and lower inflation. That's really where the Fed wants things to head.
Hey, Gunjan, you once again point to that investors should never underestimate the inclination to buy dips, and we saw it again, and it happened again. And there was a question this time. It's been working. El Arian says, don't fight that. It's working. It's been working for a long time, and it's not going to end anytime soon. That's related to the Fed, I think, because you always know you can always buy a dip because you got the Fed there. So it's related. But how will we know when that started, when we're starting to see that not work, or signs that it's not going to work next time?
I mean, I totally agree. It is related to the Fed, right? And they've done such a good job of telegraphing this tapering and their potential path for rate hikes. And that has buttressed this buy the dip trade. And, what was striking to me was Monday, as we saw the biggest sell-off in months since May, we saw JP Morgan come in and say, we think this is technically driven and it's time to buy the dip. And it certainly seems like investors continue to do that throughout the week. And you're seeing that in the futures market today. And I think especially with the higher individual investor interest in markets that we've seen over the past year, that's one key thing that people are watching is how long will this trade persist and when will it stop working? And, that's what I'm trying to figure out as well.
Shouldn't we just keep it simple and say, what, since it is in large part due to knowing the Fed is there, if the Fed starts the second derivative, just starts lessening the amount of accommodation, and you see that they've passed the Rubicon and it's starting to head the other way, shouldn't that be when the dip buying, shouldn't that be the sign that it might not be as strong an inclination? I mean, it's coming.
Yeah. It is coming, but again, they've telegraphed this so well, right? And we saw them lay out this path yesterday, and the market was still not deterred, right? The market staged an incredible rebound yesterday.
Yeah, it did. But that's what's hard to figure, because we know the market discounts things, so the market may already be discounting the beginning of tapering and maybe even moving in the first rate hikes to like late next year or something. But markets, why is
late next year? Okay, so let's just make it really, really simple. The idea is everyone was wondering if right now is the time for the market to have the Fed come in and say, hey, looks like you guys are okay. You guys are growing. If you just take a look at, let me just take a look at an Amazon. Okay, let's use that as an example. Well, let's keep AMC up here. Amazon. All right, I bought Amazon. This is personally fun for me to say. All the way during the pandemic dip. This was all the way down here. So right around this point is where the economy was like, uh-oh, there's the real, very pressing threat that everyone will be indoors for the entire year. And so Amazon was like, whoop. But then I, with my actual monkey brain, said, oh, if everyone's indoors for the entire year, then they're gonna have to use Amazon. So I put a lot of my investment into Amazon, which was a great choice because that was a 130%. So now at the end of the day, since these stocks are doing so well, the Fed may come in, and now it looks like the timeline is sometime before the end of 2023, and say, hey, looks like the training wheels, you don't need them. Looks like the economy is doing okay. But that is exactly when daddy says the training wheels are off, then the kid that's driving the bike, in fact, every single person that's involved in the economy is going to get real shook. And maybe that is the beginning of preparation for the lessening quantitative easing.
Why is the transportation average down so much, Gunjan? Do you have can you ask someone that? Or even though everything else is, what do you think?
Yeah, I mean that's a good question. I think we have seen this back and forth all year with like the value trade and the growth trade, and it looks like that's going to continue to play out. I think one key thing to keep in mind is, as you pointed out with these risks, you know, the mood has shifted in September, right? We've had a number of banks come in and say we're cautious on stocks. Morgan Stanley said there's a growing likelihood of a 20% drop in the S&P 500. So people do seem to be on edge in certain corners of the market.
She's like, you gotta buy. It's buy the dip time, but some people are scared. But if you buy the dip, you'll be okay.
Let's start, Kathy. Let me start.
No, shush. All right, so seems like that was the major update on what happened on Fed Day yesterday. That's why I do want to be able to talk a little bit about the options chain. Make sure that we've covered that. Here is once again that short interest for AMC still right at that 20.41% in terms of that short interest. So substantial. Let's see. Come over here. All right, AMC options looking like just today we are putting our sights on $100. It's interesting. Some people are just put $1 million down on $100 AMC calls. Yesterday was really about the $40 range. People made tons of money battling over $40. Right now, all those $1 million of calls from yesterday are out of the money, and the $2 million of oh my god, the $1 million of puts are out of the money, and the $2 million of calls are now in the money, which is very nice. Let's look at GME as well. I am holding GME, and yes, GME, oof, what a stock. Holding tight, holding all of their moisture in. It's like a happy sponge right now. GME has its earnings up at the 200 range, and now, even despite the Monday and Tuesday that we've had, it's still holding in all that delicious moisture, all that delicious au jus, like a tasty steak. So this is from today, this is from yesterday. $250,000 at 950. People putting bets on 950? Wow, yesterday's options chain was off the hook. Relatively. I mean, can't get that much off the hook. But that's impressive. The options chain yesterday for GME was $250,000 at $100 strike. That's substantial. Yusuf said, "Hey Andrew, what happened for Mr. Gensler, the chairman, report about GME? Do you think any pressure on him to delay that report? Because he said ready before 10 days. Yeah, he did say that. He did say that. It's really like the report is coming, like like Game of Thrones. The dragons are coming. I promise. They're gonna be like 5 of them, 6 of them. There's gonna be 100 dragons. It's gonna be 100 GME reports. Well, we can look in the news to see if there's anything about it. Here it is. Gensler's report. This is about 3 hours ago. Let's see if we have an update to share. Investors brace for SEC chairman's report on GameStop and how brokerages get paid. Ooh, now this is cool. Let's see. What is Gary Gensler on GameStop, Robinhood, Reddit saga, as well as recommendations on what, if any, changes should be made in the U.S. trading system? So here he is. Here comes his GME report. He's going to turn it in. He's going to get a gold star. Gensler told Congress his staff has been looking into both issues and promised a report by end of summer. Oh no, Gary. Oh no. The equinox already happened. I'm sorry, but the end of summer was 3 days ago. Ugh. GameStop, Robinhood, Reddit. In January, investors in Reddit chat rooms and subreddits like WallStreetBets drove up the value of GameStop shares. Many of these trades occurred on Robinhood, which subsequently struggled to keep operating. Market structure. Gensler has expressed concerns about several aspects of the U.S. trading system, specifically gamification of trading. Trading with game-like features such as points, rewards, leaderboards, bonuses, and competitions to increase engagement. He has also spoken about payment for order flow, in which brokers such as Charles Schwab send their orders to market makers in exchange for payment. It's hilarious. It's hilarious that, like, okay, we need to talk about Reddit, and then the other half is, oh yeah, PFOF, gamification, like all of these other things about the market is lumped together in the second section, where really it's just to it's trying to like make you perceive that these are equally dangerous things, whereas one, the market structure side, is really a systemic implication that the rich have made it so that they can continue to get richer off the backs of individual investors. And the other side is literally the opposite. Individual investors deciding to break the cycle, the vicious cycle, nothing virtuous about it, of turning our investments into their data, into their cash. It's just something that ends up being a tale as old as time. And thank you. Okay. We sat down with Larry Tebb, head of market structure research for Bloomberg Intelligence, for help in understanding payment for order flow. Okay, great. SEC Gary Gensler has repeatedly expressed concern that payment for order flow is a problem for the markets and that banning it is on the table. It's on the table? It's on like Donkey Kong? Is the retail investor getting ripped off? No. Retail investors are getting a much better deal than they ever have gotten. When I started in 1980, it cost $200 to get in on a trade and $200 to get out. So you might not even get confirmation of the trade for a couple of days. Today, commissions are $0. So instead of $4.99 a trade in 2019, wow, it was $4.99 a trade in 2019. Can you imagine how crazy, just how crazy the world has changed in just 2 years? Really, just a year and change. You're paying nothing other than the small cost of payment for order flow. Also, execution is way better than it used to be. The spread has tightened across the board. So the problem with PFOF is that currently rewards the spread to be larger, which is as good of a deal as you get. For example, the spread is kind of like you don't really have access to the market. You really only can tell your broker to pitch a price, and then you might get a price that's slightly less than the best price, right? But it certainly is the best price that you're going to get at that time. So it's kind of like, poor boy, here's $100. Please buy me a stock of whatever stock is less than $100. Thank you. And keep the rest for yourself. That's the spread. So the larger the spread, it turns out that payment for order flow, you get more money. And so they're incentivized to make it worse for you. But the data proves otherwise. The data says that execution is better and spread has been tightening. If that's true, if this is true, right? We need to see a little data. We need to see a little bit of confirmation here, okay? And then we'll be able to say that this, who are we talking to? Larry Tebb, head of market structure for Bloomberg Intelligence. So he's just an analyst for a newspaper, but maybe a really good one. Matt Hatter says, they're just trying to throw as many buzzwords as possible. Hashtag Gary the Goof. Oof. John Adams says, hey, brother, it's been a few weeks. Hope the folks are good. Move half my GME shares to computer share, and the process was easy. Hey, John Adams, second president. Ken Favis is in the chat. What's up? And Fabio, yo! Ryan Rang says, I would willingly pay the $4.19 and have these crooks run 65% through dark pools. There it is. Now let's see. Is payment for order flow a problem for the overall market? Here comes Larry Tebb saying it's not a problem for retail investors. It might be a problem for institutional investors or other traders who want to trade against that retail order flow that can't do it right now. Why can't they trade against it? Because of the bulk of order flow that goes to two main wholesalers, Citadel and Virtue. There we go. Oh, perfect. Market is a duopoly. Here they are. And we can actually, right after this, we are going to take a look at that dark pool data and take a look at how much of it runs through Citadel and Virtue, number 1 and number 2. What about those two wholesalers that dominate the market? Is that a problem? Some will say yes, and some will say no. Come on, Larry. The statistics don't indicate it is a serious problem. On the other hand, it's possible that other competitors might have been able to provide better execution on an individual order. But overall, it looks very competitive, and the retail investor seems to be getting a good deal. Coke versus Pepsi. Do you think this is hurting the market so that no other cola manufacturers can come in? No, it's very competitive. You can only have Pepsi or Coke. Those are the only two options. What is the, that's a little bit of sarcasm from yours truly. What is the actual cost for payment for order flow to an individual investor? We analyzed the reports filed by the brokers. The payments for order flow from the wholesaler to the retail broker is about 17 cents per 100 shares. The price improvement is 60 cents per 100 shares. Hey Joshua Beck, what's going on? Let's see. Glad to see you again, Mr. Meatball. Back at it. Hope all is well. Has he been fitted for his doggy space helmet? Meatball. He's got a couple now. He's got one in puce and one in periwinkle. He knows what he likes. What does that mean for the retail investor? It means that the client is getting 60 cents per 100 shares better pricing than if they were trading at the best bid and offer. In addition, they are getting free execution. So essentially, the commission has gone from $4.99, which was about the average commission price, to 17 cents for payment for order flow. These wholesalers say that they provide price improvement. How is that done? Right? Remember that little the pool boy that got you GME shares and said, here's some money. The wholesale executes between the midpoint and the offer. The difference between what they execute at and the bid offer spread is price improvement. And that's what the investor saves because they are getting a better price than what was displayed. Give me an example. Say you have a stock with a bid of $20 and an ask of $20.10, and someone wants to buy 100 shares. The midpoint is $20.05. The wholesaler might print at $20.08. The 2 cents between $20.08 and $20.10 is what the retail investor saves. The wholesaler captures 3 cents. The difference between the midpoint, $20.05, and what was sold for, $20.08, of that 3 cents, our research indicates the wholesaler would give about 6 cents to the broker, and the wholesaler would make about 2.5 cents. That 0.6 cents paid to the broker covers the cost of the trade. There is no commission. So the client gets the 2 cents better execution, and they also get a free trade. Okay, let's draw this all out. Let's draw it out. Let's not make you have to visualize it to make it clear. So if I had a pen, which I think I do, and the price of the stock, let's have a bid. You can also take a look at bids, midpoints, and other data like this on the trading app that I'm using over here, Webull. Bid is $20. Okay, and the mid is $20.05. So there is 5 cents missing here, right? So we have this like a thermometer. 5 cents of this is the difference between the mid and the bid. The 2 cents between the wholesaler might print at $20.08. There's an ask of $20.10, and someone wants to buy 100 shares. So there's a person that would like to buy this for 10 cents more. So they're like, yeah. Give me $20.10. I want to buy 100 shares. Then when you sell at $20.05, you get 5 cents. You save about 5 cents. So then the 2 cents between $20.08 and $20.10 is what retail investors save, right? So that's what we are. That wholesaler captures about 3 cents. So part of this red goes to the wholesaler. And then I'm going to say the blue is what you saved. That goes back to you. Of the 3 cents, that research indicates that the wholesaler will give about 0.6 cents to the broker, and the wholesaler make about 2.5 cents. So very small margins, but that's the whole point. That is at the end of the day what the market is based on, the margin. Nice little explanation. Oh, good morning, Abraham Lincoln. What's up, Duck, Duck, Duck? Greetings and salutations to my favorite data scientist, says James Turner. Have you come to a conclusion of a computer share? I'm hesitant, only because of how fast everyone and apes have migrated over. Mad love. I am also a little hesitant, but that doesn't mean that I'm not completing my research. So I'll have something by the end of this week. And remember, if it's too good to be true, you want to take the data first, okay? You want to be able to make sure that you understand it completely. All right. Let me see. So, let me keep digging. Why is Gensler concerned about that? Could be that Gensler has also said that he wants more competition in this space, but Citadel and Virtue claim that they are providing price improvement and there is competition. There's also firms like Hudson River that have announced that they're moving into the market as well. The interview goes on. Wow, there's more. Honestly, that's not, this interview is basically a prediction of what Gensler's report is going to be, and it's probably not going to be that far off. Yeah, it's Meatball. Heck yeah. Boy, do I love Meatball. Love him with all my heart. Joshua Beck says, why do stocks only crash down and creep up? Stairs to the top, elevator to the bottom. Why? That's a fun analogy. At the end of the day, you have to think about the stock market as a bit of a guessing game. It's sit alone in the dark and guess what the temperature of the room is. If people disagree, then the temperature of the room actually changes. And that's the true process of trying to understand where those bullish rises go and how a major crash could lead to either a dead cat bounce the next day or an actual reversal that makes you money. Yeah. Andrew's back. What's up, Moon Ape Army? James Turner says that answer right there is why you're my favorite data scientist. Thank you, Andrew. Kindly, says Joseph Yusuf. And Curtis says smash that like. Whoa. I agree. I agree. Mo Money is back. What's up, Yusuf? What's going on? Let me take a look. I am gonna be able to take a look at what the heck DD is right now. Yeah, the daily reverse repo update. Glad those are still here. Let's see. Oh, these are all memes now. Oh. J Powell to hold rates at near zero and kick the can down the road. We will begin tapering next year. Yeah. Let me see if I can just computer share this. Okay, I will actually have to consolidate this. Jeez Louise. What's good, says Harry Moss. How's it going? The Abays say hi. How's it going, Terry? AMC says Felicia. AMC says Harry. How's it going? Jonah friend Lee. Good morning, bro. Glad to check back every day. How's it going? FUV analysts say yes. Okay, let's see Lex Luthor in a second. ATER is today's mover. Okay, that seems like a familiar stock. Let's just have it jump on screen real quick. Oh, it really moved. Moved the wrong direction. FUV. And When Lambo. What's up, Irish Nomad? Good to see you. Irish Nomad says, greetings, we are still doing this. Heading back to Germany tonight. Night flights so I don't miss anything with AMC. Aw. Great to have you coming on in. Like nothing changed. I wipe a single tear down my cheek. Houdini says, Houdini in the house. Missed you, bro. Houdini is in the house. How's everything been? The small details. It's all about the small details. All the path that you brush it off, brush it off. Seems like I have to do a whole computer share video, so expect that later this week. I don't want people to get the wrong idea about it. AMC stuck at 72. Actually, it did get to 77 during extended hours. James says, and another quick question. Did you hear about CNBC about Smile Direct Club being the new short squeeze? Like, I hadn't heard you mention it, so I was sus. I talked about Smile Direct Club yesterday, I think, but I still don't know too much about it. I think someone from the chat talked about it. Let's see if we can find that Smile Direct Club short squeeze. What? CNBC is talking about this? This week. Nope. Can't find it. It's not on YouTube. 72K, says Cafe Ole. Aw, Mr. Let's see. Driven Lambos, says Wolfie Wild. Uncomfortable and annoying death traps. Oh, my R32 Skyline. Someone is really a connoisseur. And Jim Cramer talked about Smile Direct Club last week, too. That's pretty funny. Sorry, 2 years ago. Like the wheel turns around again. Yeah, nothing about CNBC, about Smile Direct Club. I'm on it right now. Here it is. Latest. Nothing. Let's see. Mail order orthodontics sounds like a bad idea. Sorry, STC. It's pretty funny though. How would you like to be able to smile at the safety of your own home? I don't need to see your teeth. Let's see. Bring it on back to AMC. Take it back now, yo. Do. Here is AMC on TradingView. We got a potential buy signal from the last few days. AMC was able to push past the VWAP, but that was not enough momentum to keep it above. So back down to the 40s, 60s it goes. There's that strong buy and a strong sell. Do I play poker? Love poker. Love knowing when to hold them. Love knowing when to fold them. Love knowing when to walk away. Hey guys, speaking of which, if you guys wouldn't mind, this is the only time I'm going to say it for the end of, for the entirety of the stream. If you like this content, while Meatball catches his treat, go ahead, either share it or like it, or do something with the bottom of your video right now. 3, 2, 1, your engagement check. Go. Good boy. Gabe says, I never want to be comfortable. Let's see. Who's gonna be the next Dr. Dre? Heck yeah. I already have the keyboard. D. Engaged. Let me just spritz a little bit of this. Look. If anyone remembers that from a previous video, that's a real Easter egg. Alright, so this is the Gary Gensler. Is there any other reason Gary Gensler is concerned with PFOF? Gensler has noted that payment for order flow is illegal in many countries like Canada. He's not exactly right. In Canada, they don't have PFOF, but they have broker priority for retail orders. So the broker can cut into line and trade ahead of everyone. So we're right now trying to get ahead of what the GameStop SEC report is going to be. Gary Gensler is going to put out something into the world in the next few days, next 2 weeks. It is Gary Gensler, so it might be until 2023. But in the near future, he is going to be trying to put out a report about what happened in January. So in that sense, is he fighting against payment for order flow, gamification, and what else could he be fighting against? What else could he say about the retail revolution, which he seemed to be fairly into? He seemed to be like fairly supportive of. We can also take a look at a previous interview with him to just understand a little bit of his insight, because this report can likely change a ton of the GameStop and AMC worlds. In the UK and Australia, it is much more expensive to own and trade stocks. The American economic fabric is based on people owning stock in companies. Individuals finance the growth of the economy, and our market is structured to make it efficient for individual investors to own stock. Remember that, right? If you think like, oh, America, the ennui. To be an American is to, is to feel dissatisfied. Hey, it could be a lot more expensive to be able to trade. But is it fair? We shouldn't just be pointing to another country and saying, look at them, they have it worse, right? Continue to improve your quality of living in a vacuum, and you'll go a long way. Oh, man. What is the best algo, sir? Says Farley James Aguilar. It's got to be Lux Algo. It's pinned in your chat as well as in your description, and you get 20% off with the code AndrewMoMoney. Really, really good, and has made me back in the first trade. Made me back its cost in the very first trade. There are over 100 places to execute an order. Gensler's argument is that too much of the order flow is not exposed to the broader market, and investors could be getting better prices if they're exposed to it, right? There are over 100 places to execute an order. There are 16 exchanges, 32 dark pools, and 150 broker-dealers who internalize. Theoretically, if all that order flow is placed on the exchanges, the prices would tighten. The question is, would it tighten more than 60%? The 60-cent price improvement given to the investor, or would it tighten it less? My belief is if you pushed all, this is the head of data intelligence at Bloomberg, I believe. Who is this? Larry Tabb, head of market structure research for Bloomberg Intelligence. One of the problems Gary Gensler has is that order flow takes away from the lit stock exchanges. In fact, he says this in the interview we're just about to watch. He says that he doesn't want lit exchanges to suffer. Shouldn't we be more encouraging for trading on the exchanges? Overall, yes, we should. More price discovery is good. And this is the devil's advocate here. The problem is that the exchanges are now for profit. The revenue structure has migrated to a data business. There are many other trading firms that feel like they are being charged exorbitantly for that data. There it is. There it is. Exorbitantly. Alrighty, so in that case, let us take a look at that. Gensler interview. Each time he's gone on an interview, he's essentially said the same thing since he was appointed. So here's one from a little while ago, but he is gonna likely say very, very similar things. So let's take a quick listen to make sure that you guys know what he might put out for that GameStop report sometime in the near future that will likely change the price momentum of these two stocks.
AMC Chair Gary Gensler has been weighing in publicly on some of the topics we're going to talk about here. We talk about it here all the time on Squawk. Appearing in front of the House Financial Services Committee yesterday, Gensler spoke about the meltdown of Archegos Capital Management, short selling, and the Reddit-fueled spike in GameStop earlier this year. That specifically is an issue that Gensler has spent a good amount of time on since being confirmed as SEC Chair. Gary Gensler joins us now in an exclusive interview, his first since taking on the job. Chair Gensler, it's great to have you on the program this morning. Let's start, if we could, by trying to get your thoughts on the GameStop situation, but really because it's a microcosm of so many things going on in the marketplace all at one time, right? You have sort of the social media-enabled interest in this stuff. You have these new apps, the gamification of it, you have these issues about payment for order flow. It captures all of it. But in terms of risk and how you're thinking about it, what's top of mind right now?
Well, first, let me say thank you, Andrew, for inviting me back. It's good to be back on
You're welcome.
Box and to see Joe and Becky as well. Look, I think that markets evolve and technology comes along and changes markets on a regular basis. But what we're seeing in the markets right now, as we're seeing across the country in everything that we're doing, is we're able to use our apps, God, bless, because we can get so much more access, and we're bringing more access to the capital markets for retail investors. But we also have to look out for our core principles. Our core principles are protecting investors and fair, orderly, and efficient markets and capital formation. That's written into the law, but it makes sense today, just like it made sense when it was written into the law. And so how do we update our regime, our reform our rules to still protect investors when these apps are sort of encouraging active trading through the behavioral prompts? And then our whole market structure is starting to see some concentration in it, and that could sort of diminish efficiency in our markets.
Well, let's talk about both of those issues. In terms of this issue of gamification, and you were asked and talked about this in the hearing yesterday, you clearly have concerns about gamification. The question is, to the extent you want to regulate that, how do you do it?
Well, it's about sales practices and the marketing and communication with investors. And for a very long time, the SEC and its self-regulatory organization, FINRA, that you might have heard about yesterday during the hearing, have looked at these things. So we're going to seek comment from the public about these new tools, about prompts and leaderboards and behavioral ways to get individuals to trade more. And look, there is a bit of a conflict of interest. An app that says that they have 0 commissions is earning revenue on your trading, the listeners to your show's trading, through something called payment for order flow. Somebody is paying them for that order flow and paying them for that data. We know this is to be true when we go on any application, somebody wants to get our data. But so we're going to take a look at this and get public comment and then see how we might freshen up our rules.
So, Chair Gensler, on that issue of payment for order flow, and we've had Ken Griffin on the program, we've had Vlad Tenev from Robinhood on the program, and so many others who've made an argument that because of the lot sizes for retail and the like, that they're actually getting better pricing, is the argument they say, for their customers. And so that they're saying it's not costing the end user. Do you believe that?
Well, there's evidence that shows that there's a conflict. We had a case settled in December of last year where the wholesaler in that circumstance actually had written to the broker and said, there's a trade-off. We could give you more payment for order flow, or we could give you better execution for the customers. A clear sort of trade-off. And there are brokers that don't take payment for order flow. And as I noted yesterday, the United Kingdom, Canada has banned it. So we're going to take a close look as to how the market structure can work best, be most efficient, and protect investors.
All right. So let's remind ourselves that this is the question that he asked about Canada. Gensler noted that payment for order flow is illegal in many countries like Canada. And this is Larry Tebb. He is the market structure research head of Bloomberg Intelligence. He says he's not exactly right. In Canada, they don't have payment for order flow, but they have broker priority for retail orders. So the broker can cut into the line and trade ahead of everyone else who has been waiting. It's like a dark pool. All he has to do is honor the best price. In general, I don't think you should be comparing our markets to others. And then there's EK, Australia, some other reasons why you shouldn't be comparing. Hey, how about we just look at our own country and just pay attention to that?
The solution being the issue of more disclosure, meaning as long as the customer knows this is the arrangement, it's okay? Or do you think the possibility of banning it is real and that might be a better solution?
So, Andrew, we're still at early stages. I'm at third week in this new job, and I'm so privileged and honored to be in this job that President Biden asked me to do it and the Senate confirmed. So I want to hold off on that, but I would say this. Disclosure alone may not do it. And there's times where there's an inherent conflict, and then thinking about what the market structure can be to be best for investors, but also for issuers. See, if we have concentration in the middle of our capital markets, concentration tends to lead to higher prices and more fragility. And that means even issuers accessing the markets know that there's a gatekeeper or an individual in that middle that can extract what's called economic rents.
Chair, you made a point yesterday that Citadel Securities has publicly stated that they effectively execute about 47% of all trades. Is that too much? And to the extent it is, or something you're concerned about, what kind of solution do you see?
Well, again, we're still working on it, but I'll share something else. If you or I put a market order in, again, I don't any longer because I'm the chair of the SEC, but beforehand, put a market order in on a retail platform, the vast majority, well over 90% of those go to these wholesalers. It doesn't go to the lit markets like the New York Stock Exchange or the NASDAQ or in Options World, Chicago Board, and so forth. A lot of these are really just going to the wholesalers, and they're not as lit, they're not as competitive. So it's not clear that we're actually getting best execution in an unlit, internalized wholesaler as contrasted to the lit markets.
Hey, Gary, it's great to see you. Thank you for being with us.
Great to be with you, Becky.
I'd like to.
I look forward when we can do this on the stage, though.
So do we. That would be great. I'd like to ask you a little bit about Archegos, and I know that these are all situations that you all are kind of looking into, trying to figure out what happened with it. But with Archegos, it was leverage that was the serious problem. And the Federal Reserve, after the Great Depression, put all kinds of rules in place, put leverage rules in place that used to keep people at about 50%. You couldn't be levered at more than 50%. Of course, Wall Street since then has found all kinds of ways to kind of get around those rules. And one of those is total return swaps. That was the problem at Archegos. I know you can't comment specifically on Archegos, but what can you say about leverage and about finding ways to get much more leverage than the Federal Reserve ever intended? What are your thoughts?
Yeah, I think, Becky, you raised a really good question. I want to add something. I think it was about leverage and also transparency. So when one group, in this case a purported family office, but one group wants to express itself in the markets through these derivatives called total return swaps and does it with multiple firms, then it starts to aggregate into significant positions. And we have a history in the markets to say if you have significant positions, there's transparency and the public gets to know if somebody's over 5% or sometimes it's over 10% of a company. And so that transparency was lacking here. And you're absolutely right also that through these derivative contracts in multiple banks, there was a lot of leverage in that that trade, if I can call it that.
So is transparency the problem, or is finding ways around leverage the problem, or you think that those are both things that need to be cracked down on?
We're taking a close look at both. I asked staff to make recommendations to the full commission under existing authorities to bring more transparency to this derivatives market, but also to look more closely at these issues that you raise about leverage. Now, the SEC did have authority. It took a while, but did have authority to address these securities-based swap arrangements. This came out of the Dodd-Frank reforms, and that regime is going into place later this year and then into 2022. So I think there would be some more transparency, some more control on what's called margin, which is a part of this leverage calculation. Those rules have not yet gone into place, but I think we'll need more transparency than is even in those rules.
And one more question on this. It seems like some of the rules were flouted too. Filings that were supposed to be made were never made by that family office. Are you going to be looking at enforcement for these family offices that are basically hedge funds that have tons of money and just don't seem to be following the rules that already exist?
Well, you can imagine I can't speak to a specific matter, but in general, we're going to examine and enforce the rules without fear or favor. We're going to look at individuals and corporations, and yes, that includes hedge funds, but of course I can't speak to any one individual matter.
Gary, I wanted to pivot to the issue of crypto, something that you're very familiar with. You taught a whole class at MIT about crypto. And thus far, the SEC has not gotten into the business of trying to regulate it. You've made some comments that you think that Congress ultimately will have to do it. What do you think, to the extent that it should be regulated, how would you do it? What are you thinking?
Well, so you're right. I was honored to teach not just one, but multiple levels of different courses in financial technology and in cryptocurrency and blockchain technology. I think to the extent something is a security, the SEC has a lot of authority, and a lot of crypto tokens, I won't call them cryptocurrencies for this moment, but crypto tokens are indeed securities. The prior chair had indicated that. The prior SEC brought numerous enforcement actions to sort of bring some of those security or investment contract tokens into the rules. But there are some, like Bitcoin, if I can just focus on that, and that's about half of this $2 trillion asset class right now. It's a digital, scarce store of value, but highly volatile. And there's investors that want to trade that and trade that for its volatility, in some cases just for it has lower correlation with other markets. I think that we need greater investor protection there. And we don't have a federal regime overseeing the crypto exchanges. So if an investor wants to trade on that Bitcoin, understanding it's highly volatile, highly speculative, but if they want to trade on that we have in place some investor protection. And that's what I was saying, I think, is a gap in our system right now.
But it's a gap in our system that needs to be addressed by whom? Is that something that Congress will have to address? Because it's very possible Congress won't address it. And if they don't, is that something that you think you have an angle to address?
Well, I think that as it relates to Bitcoin, and I'm not speaking to all the other tokens right now, but as it relates to Bitcoin, while our sister agency, the Commodity Futures Trading Commission, has some limited anti-fraud and anti-manipulation authority, there's no federal authority to actually bring a regime to the crypto exchanges. Whether it's stock exchanges or futures exchanges, there's regimes that were put in place in the 1930s to help protect against fraud and manipulation on the exchanges and protect the integrity of that. And I think that's really something that we'll be working with Congress and if they see fit to try to bring some protection for people that want to invest in this speculative asset class.
In terms of that protection, though, how do you think of the role of social media? I mean, this goes back to GameStop, but also you're seeing it in crypto. Elon Musk is going to be on SNL this weekend. We've watched Dogecoin nearly double over the week as people speculate that he's going to do a segment or a skit around that. He's been on Twitter talking about these things. What do you think of the celebrities taking to Twitter? We're looking at a tweet right now. Let's find out how live Saturday Night Live really is. And literally just on the backs of these kinds of communications, you're seeing stocks move, you're seeing crypto move. When you think about investor protection, what do you do about that, if anything?
So I think that we've lived, every decade we get new technologies. There were debates 100 years ago whether to allow a telephone on the floor of the New York Stock Exchange. And here we're in the 2020s. We need to update and freshen our rules to ensure that while retail investors and any individual has First Amendment rights to speak and so forth, that they're not misleading the public, they're not manipulating the public, manipulating the markets. In the securities field, we have a lot of authorities to do that. In a number of these crypto fields, not so clear if it's Bitcoin, for instance, which has been deemed not to be a security. But I do think that we're going to be freshening up our rules and really hearing from the public. I think that the community and the social media is good, but let's recognize also that now computers can train on that social media, do something which is called sentiment analysis. This is computers watching our words. In fact, this interview right now probably is being interpreted in sentiment analysis, meaning a computer somewhere is taking Andrew's and my words and saying, what does it mean for the markets? Now, the stock market's not yet open, but what does it mean for the markets?
Hey, Gary, I don't know how far you want to go on this, but just take yourself away from SEC chair for a second. And just as a guy who taught courses at MIT, and I guess you didn't teach a course, you didn't call the Bitcoin or crypto course Ponzi scheme or tulip mania, or it was on crypto. So, and we have a lot of uninformed opinions. People call it a Ponzi scheme. People say it just takes the greater fool theory. Someone has to pay for it. There's no inherent value. Just as someone who knows how it works, you called it a store of value. Were you just referring it to that as a perceived store of value, or in your view, is that the mechanism itself, does it imbue Bitcoin with actual value that people now ascribe to it, that it's similar to digital gold, in your view?
So I think what's important at the SEC is to be technology neutral and still stay to our core principles of protecting investors, capital formation, and those efficient markets. In that sense, and working with Congress, I'm saying I don't think there's that investor protection for Bitcoin investing at this point in time. Now, how has it been perceived by investors, and what did I teach at MIT before this, is that it's a digital, scarce, speculative store of value. It could go to zero, or it could go high, and that's the nature of it. But I think bringing investor protection to that market is relevant if this is going to continue. And it brings confidence and trust to investors in overall markets. We found that in the equity markets. We found that in the bond markets, that when we bring investor protection to those markets and we try to our best within our resources to tamp out fraud and manipulation and other bad actors, that's good for capital formation.
Gary, it's on some corporate balance sheets as a alternative to cash. And, you know, when I hear Fed Chair Powell or Treasury Secretary Yellen talk about it, I hear one thing, which would make me think you'd have to be absolutely insane to put hard-earned corporate dollars, a cash manager, to put it in that. Can you give us any more than it could be worth zero, or it could be worth $1 million?
You know, I know Joe, there are other guests you're going to have on for the next 4 years or however long I'm graced to be in this job. I'm not going to speak about valuations. That's your other guest.
I figure MIT, you'd know whether blockchain is for, I figure you'd give it the slightest little bit of an endorsement. I'm not going to get that.
I got the tease that you're trying to give me, but it's not my job right now. But what I would say is important is disclosure. You mentioned corporations. Disclosure, that's been our hallmark for 90 years of our capital markets, that a company discloses what's relevant to investors. And we're also, it's critical that whatever that disclosure is accurate, not misleading, and doesn't leave out material omissions.
Hey, Chair Gensler, help us with this. And maybe I'm just curious actually about your philosophy when it comes to investor protection, because right now there's such a divergent view of what investor protection means. There's a lot of people who look at the interest in the markets and say it's really exciting, but there's younger people that are getting in the markets, that hopefully they're learning about the markets, that this is going to help the markets longer term. There are people who say actually there should be less investor protection to some degree, and in fact that the investor protections that we've historically have actually not protected the retail, but they've always protected the establishment. You hear that all the time, the suits, if you will. And we've been criticized on this very program for talking about that, or for trying to, quote unquote, try to protect the investor the way we've talked about historically. How do you think about that right now? And also the idea that certain investors have access to certain types of products that others don't.
Well, I don't know whether you were commenting that I should take off my jacket and you guys aren't wearing one, but wow. to your question, at the core, I think investor protection has helped economic growth. I think that investor protection has helped capital formation because it builds trust and confidence in our financial markets, and I think it lowers what's called the risk premium. It lowers the risk that somebody's defrauding the investors. Now, investors can take risk. That's at our core of our sort of public policy. Investors can take risk as long as they have that disclosure, all of those what's called material disclosures from an issuer, somebody raising money, somebody investing, and that those disclosures be kept current, and they are updated, as we know, quarterly and annually and the like. That's how I think of it. I think about the exchanges where there's not that protection yet on the crypto exchanges, but on the exchanges to ensure that there's integrity and that if somebody says there's a bid or an offer, it's real. And then thinking about this market structure and these events around January's volatility, is it the most efficient market? Meaning, does it help lower the cost through a lot of competition? Competition and transparency is contrasted to darkness and concentration. So that's the balancing, but bring transparency and competition in markets. That's good for investors. That's good for issuers.
This one's a little theoretical. The biggest issue for regulators trying to see things before they happen, and regulations often are only put in place after there's a crash, after there's a fiasco, after there's a situation where people lost a lot of money. It's just natural because there are so many lobbying organizations, so many blocks that are put up to try and keep the system status quo and as it is. But if you were looking out there, if there's one or two things that you're most concerned about, we did hear from the Fed yesterday that they're concerned about asset prices dropping really rapidly as they've gone up so quickly. If there's one or two areas that you're really concerned about, maybe preventing things before there's a crash, before there's a big problem, what would they be?
Well, I think the heart of yesterday's testimony was trying to get ahead. Technology has been a good thing, bringing a lot of access. It's easier user interfaces on our mobile apps, not just in finance. That's generally been a positive outcome. But to guard against that, we don't lull ourselves into a place that we're not protecting investors and we're not ensuring for that market integrity that I mentioned earlier. So I think it's good working with the staff and my fellow commissioners to get ahead of that. I also think disclosure, that we're in a new decade and investors want to understand more information about climate risk and human capital and the drivers of value inside of the businesses and the drivers of risk inside of the businesses. So these are a number of the areas that we're going to be spending a fair amount of time with.
Chair Gensler, we want to thank you for being with us. Hope you come on back, because I do want to talk about climate. We have about 1 million questions about SPACs that we want to get to. I'll leave you with this. Are you going to be watching Saturday Night Live?
Was you going to be watching Saturday Night Live? Ooh, I guess we'll never know. So that is Gary Gensler once again with his comments. This is really the only comprehensive interview that we have with the man, the Gary, the GG, no re. This is an article from Bloomberg Intelligence talking real quick about what is happening with the Gary Gensler GameStop report coming out. What about the sub-penny rule? Right now, exchanges can't trade in increments below a penny, but market makers like Citadel and Virtue can execute in sub-pennies. This is an unfair competitive advantage to those wholesalers. There should be a level playing field where everyone trades in, say, half-cent or quarter-cent intervals. So there it is. Congress has been grilling him on this issue from day one. It's clearly an issue for them. It's also got tied in with the GameStop issue. It's kind of like GameStop. The market is seemingly very, very broken. How do we fix it? And they just kind of slap a bunch of other stuff on it. And then slap a bunch of other stuff. What's up, AJ? Good to see you. Thank you guys. I appreciate that. SpongeBob's snail is faster. Well. What do you recommend about done for payment for order flow? So this is what the Bloomberg Intelligence head of market structure research is going to say. First, the rules are a bit antiquated, so they should be updated. We need more disclosure. For example, the reports of wholesalers on how fast orders are filled should be updated. They also don't include odd lots. They should also improve the benchmarks for pricing large orders. All of this would provide greater information so that investors can better understand how the orders are being executed. And as you increase disclosure, it increases competition in the marketplace. So there it is. Bottom line, the US market is very efficient. Banning payment for order flow would hurt retail investors, in the opinion of this market research guy. We can improve the markets by providing more disclosure that would make the markets even more efficient without disadvantaging retail investors. Another way to do this is to make payment for order flow optional. In my opinion, seems pretty simple. Payment for order flow, just opt in or opt out. You want to pay for payment for order flow or you don't. Now, the problem with that is that that is going to give people essentially a, would you like to pay $5 or $0? And people are like, what do I get for $0? And they're like, we'll just use your data. And then people will actually learn more about it. So that's a double-edged sword. People are likely going to choose a $0 option if you have the choice. But if they did have the choice, they'll learn about why they are getting a free trade. And then suddenly, we don't have to ask them to go down a YouTube playlist or a Reddit rabbit hole. All they need to do is just ask the question, why is this free? If one of the options is that I have to pay $5. Oh, man. Stone Get Money says, I see a lot of buys, hundreds, 200 shares, and then you see 1K, 2K shares being sold. Not that many apes holding more than 1K shares. What's up, David Barr? Good to see you. 26 million volume, yeah, pretty darn low. Pretty low. 34-year-old on track to reach $1 million net worth. 7 money habits you should adopt before you turn 40. Is this okay? It's trending. This is how I started my my YouTube channel as well. It's like, how do you become a millionaire within a million years? At 34, they have a net worth of more than $700,000, mostly from my earnings, retirement accounts, home equity savings, and investing accounts. I'm currently on track to have a net worth of $1 million by my 40th birthday. By this article, it seemed like she was already really close. Save. Okay, so real quick, save and invest at the same time. Don't be afraid to quit your job for a higher paying one. So important. Oh my God, I had like 3 or 4 videos about this. Guys, don't work a bad job. Just be unemployed. I'm not giving you life or financial advice. I'm saying that that's something that I would do. I feel like if I didn't feel appreciated at my job and I feel like that I would be able to be qualified for another, I would much rather spend the time 5 weeks, 10 weeks at a time, collect unemployment, right? That's the point of insurance. That's the point of why the government is paying for unemployment, so that you grind and get a better job. Don't sit on your butt and do nothing, right? Work for it. Every time you get an increase of about 30%. There's a whole video that I put out that said every time I got a brand new job, I got a 30% boost. Avoid lifestyle inflation. Yeah, don't buy more stuff that you can't afford, obvi. Don't create a rigid budget that you can't live up to. Interesting. Okay. Don't create a budget that you can't live up to, but also don't make your life more expensive. I guess keep a plateau of your life realistic. Build professional relationships early on in your career. So important. A good friend or contact from a good company, especially in tech, especially in finance, you will likely see them blow up in their career, and then you can easily just jump in and party with them. Houdini says, Gary. Let's see. What up, Andrew? Says Roderick. People want to take a look at a couple of stonk research. Good. A couple of stonks to look into. I'm happy to. Keep tabs on your credit report every month. A $12,000 brush with credit fraud in my early 20s sparked an obsession to check my credit report for fraudulent activity. Yeah, use Credit Karma. Yeah, that's what I use. Pretty good. Hire a financial advisor if you need tackling big challenges. Yeah. Don't do this if you are not buying something big. But if you are buying something big and you don't have a friend to help, you definitely want to hire a financial advisor. Remember, I am not a financial advisor. So you cannot hire me. And that's it? I thought there were 10. Huh? 7? 7 money habits? Pretty good habits, actually. I am satisfied. Adrian says, can confirm kids and avocado toast are expensive. You can only have one or the other. Think it to yourself right now. Would you rather have kids or avocado toast? Have that in your brain. Okay, now put it put it into reality. Ryokan says, so glad you're back. Aw, what's up? What's up? I haven't heard of this person. Avocado toast is Matt Blair comedy. Matt Blair comedy? Long time no see. How you been? Whoa, whoa, whoa. Are you saying that Matt Blair comedy is here? The comedian? The Matt? The Blair? Insanity. Oh, man. Financial advisor to Meatball. I'm actually taking financial advice from Meatball. Meatball is my financial advisor. Here you go, bud. There you go. There you go. But yeah, I think don't skimp on professional help is a great piece of advice. I don't really know it. Don't skimp on financial advice. I don't really have a big financial thing that I need to do. So there it is. But if you guys like that video, like some of you seem like you were kind of engaged. We can cover that kind of content again. How do you make the 6 figs in the 6 months? Let's see. So AMC short interest still about 20-ish%. Wolfie Wild says more positive vibes. Let's keep it going. Heck yeah. Aw, it says John Leo says you're a site for SOT. I'm a site for. Matt Blair comedy says I like my baby. Avocado toast is good though. Hot for ATER this morning, especially after this dip to solve their debt. So let's see, ATER dipped all the way down to the 1181s. Now you're already seeing a 20% rip in a matter of minutes from the lowest of the lows. Let's go out to the hourly. Ooh. This stock just bounced off of the EMA here as that 200 interval EMA bounced off of it, and that was a predictable bounce that you could have played because this stock seems to bounce off of its EMA often. Here's two examples. Here's another one. Here's the third one. And here's the fourth one. So if you called the bounce at $11 because you were like, that's the EMA right down there, I'm going to buy right before that happens, good job. ATER looks like you could see a potential reversal, especially since this actually could end up being a... How many weeks is this? Only 1 week. A 1 week intra-week cup and handle. Intra-week cup and handle. If this ends up surpassing its SMA, the blue line here, 1598s, it could end up going ballistic. Or it could be a dead cat bounce. That's the problem with these stocks. You need to understand the entire picture. Computer share. I'll come out with a whole computer share video in a sec. Alright, so you guys saw that FT, you guys saw that Gary Gensler vid. One of my faves, honestly. Is there one that's similar to that? So here's the one from a week ago. Wow. Gensler was on here a week ago.
Sure, Gensler, I'd love you to listen to a response as well, though, from the Virtu Financial CEO, specifically about you and what he had to say in terms of what he claims is you conflating some issues when it comes to payment for order flow, and then get your response.
He's conflating the issue of payment for order flow and the inherent conflict, which has been addressed and dealt with for the last 30 years by the SEC, with order routing and price improvement. Two separate issues, and the data around price improvement is so overwhelmingly compelling. $11 billion of price improvement in 2020.
$11 billion, and zero commission trading in this country. Game, set, match.
Game, set,
Your
match.
response?
Well, let me just address. I don't think that the disclosures that are put out really address the question about whether people are getting best execution. So best execution means best execution. And so we have something in America where nearly half of the trading is going to dark pools and to the wholesalers, one of whom you were just interviewing, wholesalers that dominate and concentrate the market. And even that which is on the so-called lit markets, the New York Stock Exchange and NASDAQ, many of the trades there are not being fully displayed. So this concept of price improvement is against a measuring stick, which is a measuring stick that's not fully reflective of the market. Our consolidated tape, our national best bid, best offer, so to speak, does not reflect the half in the dark markets. It doesn't even reflect a lot that's on the exchanges. So if you or I make a trade, a market order retail trade, where does it go? 90+% chance it goes to a handful of wholesalers, one of whom you were interviewing. I would say that's a conflict. And the thing that we're trying to do is update our markets for the 2020s. They were last seriously updated in 2005. A lot's changed in those 16 years.
You know, Mr. Chairman, I want to follow up on that.
Oh, it's Jim.
Payment for order flow, and I understand what the Virtue Fellow said, but isn't it true that if brokerages are optimizing their digital engagement practices for their own revenue, that may not be exactly on the same page as what of giving investors the best returns? So therefore, investors should know ahead of time that they may not be getting the best returns by so-called paying no commissions?
Jim, I thank you for that. You're absolutely right. So today's data analytics aren't what you and I learned in college. They're very sophisticated, and they can optimize for the trading platform or the robo-advisor to maximize their revenues and their data collection. That may well be in conflict with your investor returns when they're trying to use a behavioral prompt to get you to trade more or to move into one of their investment products. Secondly, you mentioned zero commission. Zero commission does not mean it's free to the retail public.
No.
You may not be getting best execution. And so that's what our economists, that's what we're looking at very closely to see, can we do better? And I think that we can do better than the regime that was laid out 16 years ago.
You know, when we talk about regulation exposure to a number of new platforms and technology, not just in financial services, one thing we keep coming back to is the popularity of the platforms creating friction for regulators. Is it any more difficult to regulate something that's popular? Maybe because the client base does believe it is zero commission?
Well, you raise a good point. Technology has come along and changed the nature of finance. I mean, the internet came along and that changed the nature of finance as well. So these are the challenges we have. It makes it an exciting job. But at the core, what we're trying to do is get competition in the market. I mean, it's a basic thing in America. I'm deeply a markets person and believe in transparent trading and competition, order by order competing. And right now, we have large wholesalers buying a bunch of that order flow. And so that the retail public, most of your trades are going to a small handful of wholesalers. And in fact, they've publicly announced there's a high concentration amongst 2 or 3 of them. And that's not the lit markets of New York Stock Exchange or NASDAQ as we know them.
Well, there it is. So Gary Gensler had to talk again, and that was just a tiny amount ago. Hey, thanks guys. We spent an hour and change together, and we will have more videos. Not only because you like them, we'll have one about how we got to 6 figs in 6 months. We'll also talk about the computer share situation, as well as who do you trust when these reports are coming out, and what kind of policy changes are actually best, and what is just darn old propaganda. Hey, thanks again to those of you who make this show possible. Moon, Platoon, Grillier, Space Legend here. If you guys don't see your names on there yet, I am updating this list because I want to see you guys on the end screen for supporting the show. If you guys like this show, make sure to drop those subscribbles, those bell buttons, and those likes, because if you guys come back and comment on this video, you might just see yourself in a future raffle and win a little something or another from AndrewMomoney.com. I have been Andrew Momoney from Twitter and Instagram. You can follow me right there if you wanted to see some pictures or some thoughts from my brain and get caught up on the market. And always know that you guys can grab your six-figure portfolio from yours truly if you guys go and support this show from the join button down below, and you also show yourself on the screen, or the Patreon link in the description. Grab your 20% off with the code AndrewMomoney on Lux Algo, and we will see you in the next video. Peace. Pa.